Hello everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predict gold prices. In my last video I said gold could bounce up during the summer, and it has actually gone up a little bit below 1800 and it went above 1800. So let's see where we stand now. Let's take a look at the Gold Forecaster Index. It has perfectly followed the gold price and predicted it very accurately because it is based on leading indicators that you can see here. And the latest data point says that we are going up. We have this gap here above zero, so we are in positive territory and it is getting better. So I expect that gold will continue higher at a faster pace now. So I think we can quickly go into 1900, 2000 maybe at the end of the year. We also got new data on the Taylor rule rate, which is calculated from GDP and output gaps. So the new data point here is this one, and it is higher. So that means that gold is going higher. When you look at the historical chart, when the blue line is above zero, you see that gold typically goes up. These are very long time frames, so multiple years. When the blue line goes below zero, you see that gold is going down. Now we are hugely positive here, so I think that gold has a lot of chance to go higher. Misery index hasn't changed, but we do know there were bad numbers on the unemployment rate, ADP numbers, so we still have inflation. So I think that this misery index is still elevated. That's also good for gold. Real output, we don't have new numbers yet. I'm waiting for the Q2 numbers. Very eager to know where this blue line will go. Supply and demand, let's take a look. That's important for the silver price. We see that copper production is flat, so nothing has changed. In Peru, we have a small uptick in production, so that's a little bit bad for silver, but this is actually very stable. Nothing to see here from GLD. GLD is actually very stable. I had hoped that more institutional buying would come in gold, but it's actually just stable. Same with COMEX. We also got new numbers for China and India demand, and the numbers were pretty good. So Chinese gold demand is stable at this level. Silver demand is actually very high. So these are the silver columns, and silver demand has actually gone higher in July, and India gold imports were also higher, at least higher than last year, but down from the previous quarters. Chinese silver demand has actually gone down here, but I'm hoping for a pivot here. So it doesn't look that great for silver. Also here, PSLV had very low premiums. I think the Wall Street silver guys are not buying anymore. The PSLV holdings have not gone up. So I think the hype is over on silver. didn't have new numbers on central banks. US mint sales were stable, so it stays at this level here and also here. It's higher than last year, but nothing has actually changed here. So very stable. Premiums still at 50% for the coins, but a new trend has emerged on the junk silver. And you need to know junk silver is primarily bought for their silver content. And that follows the spot silver price very closely. So I think this is real demand for silver because you don't buy junk silver because it's nice, it looks nice, but you actually buy it for the silver content. And you can see here that the premiums on junk silver have come down. That's not a good sign. It was around 50%, now it's around 15%. So I want to see a spike in these premiums because that would signal a bottom in silver. Like here, that's a bottom. And here, a bottom. But now it has come down, the premium. It's almost at the historic 5%, 10% line. So I think we should stay out of the silver market until we see a change here. For the coins, yeah, it looks a little bit better. But if I need to choose between these two charts, I think this is more accurate. So I'm not a huge fan on silver yet. Premiums for China were close to zero. So demand for gold and silver is very muted. PSLV premiums were down. Let's take a look at the COT reports. Nothing to see here, very stable. Stable is the word today. And on the silver COT report, it's better. So open interest has gone down and the shorts have covered. So silver looks better on the short term. So we could have a small bounce up on silver, but in the long term, we need to look at the premiums and those have not gone up yet. Here you can also see that short term, the net silver swaps have gone up. So that signals a short term bottom in silver. Could bounce higher, but don't expect it to go to 30 or 40 or triple digit silver. That's not going to happen at all. Backwardation. Yeah, the lease rates were pretty stable. Nothing to see there. I can show you that. So lease rates are very stable at this line here. And the trend line for silver is also stable, slightly to the downside. So that's not a good sign for silver. Swiss franc has actually gone down a bit. So that's why also gold has been going down. The tips. Let's take a look. We are at the bottom range of the 5-year, 10-year tips. So gold could bounce a bit to the 1900 level. This is a chart of real yields. Normally, gold should follow this blue line, but somehow gold is actually going down right now. So this is a phenomenon that I have not seen before. So either gold will need to bounce back or we need to see a massive rise in real yields. For example, when inflation drops or when bond yields go higher. But I think that gold will bounce. And another reason is because we are now in August, and that's the bottom in gold seasonality. So I expect gold to go higher in the coming months. Silver will be a bit more stable, but gold will go higher like this. Sentiment indicator on gold miners tells us that we might have a bottom here. So we went down, sentiment was down, we could have a bounce now. Let's go over to the balance sheet. So all the balance sheets are up, and the Fed is actually buying more. You can see that the STOPE has increased, and ECB is also buying. And you can see here that they are buying mortgages and treasuries at a steady pace. On the balance sheet, we can also see that the repos, reverse repos, are going up, this blue line, and the TGA account cash is going down. So I expect that in a month or two, this cash will be depleted if they don't increase the debt limit. But I think they will increase the debt limit and this treasury cash will be going up again. So they will borrow more money and that will boost the markets again. So I'm actually very positive on the markets. The reserves here are still at 4 trillion, and that's why all of that money is being channeled into this reverse repo number here. You can see here the reverse repos have hit almost 1 trillion to make sure that the Fed funds rate doesn't drop. You need to make sure that the Fed funds rate stays at this level. The money supply, let's take a look at that. Money supply is still rising, but the latest data is actually showing that it's almost dropping. So that's not a good sign. That means that inflation is going to go up slower. So this was the STOPE, and here you see that something has changed. So it's not going up that fast anymore. We need to watch this because if this goes down, then we have deflation. Very important to watch this chart. Let's take a look at the deficits. Deficits have gone up. And here you see that the services surplus has gone down again from 18 to 17. And the goods deficit has also gone up. So all in all, this is the deficit chart and it's going down more and more. The gap between imports and exports is widening, so that's a sign that deficits will keep going higher. That's bad for the dollar and good for gold. Both are rising, so that's inflationary, export and import prices. So we're still in inflation. So that means we need to stay in commodities and in precious metals. Capacity utilization is a sign of inflation, and the latest number says that we went up a little bit. So we're still in an inflationary cycle. So let's watch this number. If this keeps rising, we're still in inflation. That's also the seen from the PPI, the producer price index, still going up, but not as fast as before. And break-even inflation rate is up, but lately it comes back down, so it's again very stable. Now, something I wanted to tell also in this presentation is that BMO Capital Markets has given their outlook on commodity prices. As you can see, gold should be going down by 10%. I don't believe that, but at least this is much better than, for example, iron ore or tin or palladium. So if you own one of these, for example, iron ore, then you should get rid of it. Iron ore has done very well, and it's pretty much time now to take profits, and then you can transfer that into one of these. For example, silver or nickel, platinum, gold. So these are much safer at this moment. Just wanted to show this. Also, this one, iron ore price is going to go down. The demand is actually leveling off now into the coming years. We also got numbers from China power consumption. The growth is going down, but we still have high growth in GDP and in power consumption. If you look at the long-term trend, it's still going higher. So China is still growing at a very high pace. Okay, so I wanted to close this presentation by talking about Yardeni's outlook. So last week, Yardeni has changed its outlook in a positive way. So as you can see here, the old chart says that the stock market, the S&P 500 index, would go to 4,300, and then in 2022 to 4,800. Now Yardeni changed that to 4,500 now and to 5,000. So that means that we will go up 10% from today, more than 10%. So that means the stock market is going to go higher, commodities will also go higher, banks, oil, everything is going to go higher. And what's very funny is once I updated this on this blog, Yardeni increased its forecasts just one day later again, and it increased it like this. So Yardeni said now in 2023, the stock market will go even higher to 5,400. So that's another 10% increase, and cumulative, it's almost 30% increase from today if you just wait 2 years. So I mean, this chart tells me that you should buy everything. Everything will go up. Precious metals will go up, stocks will go up, even I think even bonds will go up, which means yields will go lower. everything will go up except for one thing, and that's the dollar. And I'll see you in the next video. Bye.